Ever wondered how you can grow your wealth while minimizing risk? Investing in mutual funds might be the answer. In this video, we'll dive into the different types of mutual funds, how they work, and what you need to know to make smart investment choices. Let's get started. Number 1. Types of mutual funds. Before investing, it's crucial to understand the different types of mutual funds and how they align with your financial goals. Equity funds, which invest primarily in stocks, aim for high capital appreciation, offering growth potential, but with higher risk due to market volatility. They can be categorized based on the size of the companies they invest in, such as large cap or small cap stocks. Debt funds, on the other hand, focus on bonds and provide a more stable income with lower risk, making them ideal for conservative investors. While debt funds are less volatile than equities, they are sensitive to interest rate changes, which can affect their returns. Hybrid funds combine both stocks and bonds, offering a balanced approach by providing both growth and income, making them a good option for those seeking diversification without taking on the full risk of equity funds. Lastly, index funds aim to replicate the performance of a specific market index, such as the S&P 500, through passive management. These funds offer broad market exposure at a lower cost and are popular for long-term investors looking for gradual wealth growth. Each type of mutual fund serves different purposes, and understanding their characteristics is essential for aligning them with your risk tolerance and financial objectives. Number 2. Risk and return. Understanding the relationship between risk and return is crucial when investing in mutual funds. Equity funds, which invest in stocks, carry higher risk, but also the potential for higher returns, as stocks can experience significant price swings, especially during market downturns. While they may offer better long-term returns, equity funds require a long-term investment horizon and the ability to withstand volatility. Debt funds, on the other hand, are safer and less volatile, offering lower returns in exchange for stability, making them suitable for conservative investors. The key advantage of investing in mutual funds is diversification, which helps reduce overall risk. A diversified portfolio, such as those found in hybrid or index funds, spreads investments across different asset types like stocks and bonds, which can buffer losses during market downturns and improve the risk-return balance. Diversification helps mitigate the impact of any single asset's poor performance on the overall portfolio. Number 3. Fees and costs. Understanding the costs associated with mutual fund investing is essential, as even small fees can erode your returns over time. One of the most significant costs is the expense ratio, an annual fee charged by the mutual fund company to cover operating expenses. This fee is expressed as a percentage of your investment in the fund. So, for example, if a fund has a 1% expense ratio and you invest $10,000, you'll pay $100 annually in fees. Actively managed funds typically have higher expense ratios compared to passively managed index funds due to the additional oversight and management required. In addition to the expense ratio, some mutual funds charge load fees, which are commissions added when you buy or sell shares in the fund. There are two types of load fees: a front-end load, charged when purchasing shares, which reduces the amount invested, and a back-end load, charged when selling shares, but this fee decreases over time the longer you hold your investment. No-load funds, which don't charge these fees, can be a better choice for long-term investors looking to minimize costs. Being mindful of these fees can help maximize your investment returns. Number 4. Investment horizon. When selecting a mutual fund, it's important to consider your investment horizon, or how long you plan to keep your money invested. Long-term investors can typically ride out market volatility, making equity funds a good choice as they tend to offer better returns over time despite short-term fluctuations. With several years or decades to invest, you can benefit from market recoveries and compounding growth. On the other hand, short-term investors may need to opt for less volatile funds, such as debt or hybrid funds, which are more stable and less prone to significant value swings. These funds are better suited for those who might need quick access to their money without exposing themselves to major risks. Number 5. Due diligence and research. Before investing in any mutual fund, thorough research is essential. Key factors to consider include the fund manager's experience. A skilled manager with a strong track record is crucial for delivering strong returns, while less experienced managers may struggle. It's also important to review the fund's prospectus, a detailed document outlining the investment strategy, objectives, risks, fees, and historical performance. Understanding the fund's approach and its potential risks is critical for making an informed decision. If you're uncertain about which mutual funds to choose, consulting a financial advisor can be beneficial. An advisor can provide personalized guidance based on your financial situation, goals, and risk tolerance, helping you make better investment choices. Number 6. Tax implications. Mutual fund investments can have tax implications that affect your returns. When a fund sells securities for a profit, it generates capital gains, which are passed on to investors and may be subject to tax. Short-term capital gains, for assets held less than a year, are taxed at a higher rate than long-term gains, for assets held over a year. To minimize the tax impact, consider investing through tax-advantaged accounts such as IRAs or 401ks, which allow you to defer taxes on gains until retirement. This can lower your overall tax burden and enhance your investment returns over time. Number 7. Regularly review your investments. Once you've invested in mutual funds, it's essential to regularly monitor their performance and make adjustments as needed. Rebalancing your portfolio ensures your asset allocation remains aligned with your goals. Over time, some investments may outperform others, causing your portfolio to become unbalanced. For example, if equity funds have gained significantly and now represent a larger portion of your portfolio than desired, you may need to sell some equities and invest in debt funds to restore balance. Additionally, monitor fund performance by comparing it to relevant benchmarks and other similar funds. If a fund consistently underperforms or no longer aligns with your objectives, it may be worth considering a different investment. Number 8. Additional tips. When investing in mutual funds, it's wise to start small and gradually increase your investment as you gain confidence. One effective strategy is dollar-cost averaging, where you invest a fixed amount at regular intervals, regardless of market conditions. This helps reduce the impact of volatility and lowers the average cost per share over time. During market downturns, avoid panic selling, as this may lock in losses and prevent you from benefiting when the market recovers. Additionally, it's crucial to stay informed about market trends, economic conditions, and interest rate changes, as these factors can significantly affect the performance of your mutual fund investments. Investing in mutual funds can be an effective way to diversify your portfolio and grow your wealth over time. However, it's important to approach mutual fund investing with a clear understanding of the risks, costs, and strategies involved. By researching the different types of funds, considering your risk tolerance, and regularly reviewing your investments, you can make informed decisions and potentially achieve your financial goals. Now that you know the ins and outs of mutual funds, it's time to start making informed decisions about your investments. Don't forget to like, subscribe, and hit the notification bell for more tips on building your financial future. See you in the next video.